Okay, folks, in this video, I'm going to discuss profit targets and also discuss volatility. Now, when I say profit targets, let me be clear that what I'm referring to in this case is how far do we believe the stock price is going to move. In the case of trading options, if I'm buying calls or puts, it's what the stock is doing mostly as far as its directional movement that's going to have the greatest impact on the value of my options. So therefore, it's important for me to have some idea of how far I believe the stock price is going to move up or down. So let's start from this example. So this is a great example of a stock that moved up sharply. This stock, DWAC, started the day off at about $16.80 a share, and it went up to $25.80 a share, which is a very large move. And of course, that would be worth a lot if we were trading that with options. So if we're looking at a large percent change like that in the stock's price, that could dramatically increase the value of options because most likely this price move was not expected by the market, and therefore the options were probably priced to reflect smaller amounts of range of movement than what we saw. But let's say that we were looking at this stock and we spotted it early in the session where it was just beginning to go up. So let's say we spotted it somewhere around here. Now, if we spotted it around that time, that's within the first 15 minutes, first of all, as we discussed in a previous video, that first 15 minutes of the session is extremely important to help us to recognize a trend. So by the first 15 minutes, in fact, before the 15 minutes were even done, it was pretty clear this stock was moving up. It was already on a trend up. Now, once I discover the stock, if it's still in motion, right, and I've discovered it fairly early, one of the ways I can deduce which direction or how far the stock might go in one direction would be to measure the distance it's already moved from its opening price until now. So in other words, if I look at the distance from where it started to where it is at the end of that period that I first identify it, maybe the stock has moved up, let's say $2 a share. In this case, the stock moved up just around $2 a share from where it started. So if it's already moved $2 a share and it's very early in the session, in this case, it's only the first 1, 2, 3, 4, 5, 6 minutes. So within that short of amount of time, if it already moved $2, that's giving me an idea of what pace it's running at. So think of it like if we saw someone who was running a race, if we can see how quickly they can cover the first part of the race, we have some idea of how quickly they might be able to finish the entire event based on their pace. So if the stock is starting off at a pretty strong pace, we can expect that that pace will be continued over time, but it may not go as quickly in this case. So we can now say, well, maybe it can go a certain distance more if we give it enough time. So by enough time, I simply mean that if we let the market continue trading for the rest of the day, I can realistically expect that the distance covered in that first 6 minutes could be duplicated if I give the market much more time. So if I give it another couple of hours, let's say, there's a good chance at that speed at which, that rate of climb that it was going early, there is a good chance that it may be able to replicate that as we go forward. So in other words, if I'm getting in to the trade when the stock is here, I can realistically expect that by the time we get to the end of the day, hopefully a lot sooner than that, the stock may be able to go another couple of dollars in this case. And that's what it did here. By the time we got to about right here, the stock by that point moved another $2 or so. Okay, so we could project that. So when we choose the options we want to trade, we need to make sure that the stock goes that other $2 a share. It's going to be worth it to us. In other words, we're going to make a good enough profit. Now, generally speaking, that would be the case because options have an asymmetric return, meaning that the more the stock goes in your favor, the more the value of that movement in your favor becomes, and the more the stock goes against you, the less the impact against you becomes. So because of that, if we are basically saying that we think the stock can go up another couple of dollars, that couple of dollars move up should be worth more in profit to us than if we saw an opposite couple of dollars move down. But obviously, as we said in a previous video, we want to cut our losses when we're down about 30% of our options premium because that would be evidence that we got in at the wrong time and that things are not working out at all. But if they do work out, we should be able to see the options go an equal distance that they did at the beginning of the session later on in the session, and that should allow us to make a substantially greater profit than what we were risking. Also, we should keep in mind that sometimes stocks move up so fast that by the time you get through that first 15 minutes, they've already done everything they're going to do. And if that's the case, we'll find that out the hard way. But one way to actually figure this out is if I look at a stock and it's just going straight up. It's very vertical in its movement, like something like this early in the session. If it's going up like that, most likely it's not going to be able to keep up that pace. One of the good indications that the pace can be maintained is if the stock steadily stays at the top of the price channel and it moves smoothly. The bars are they're not too large in size like this one. The bars look like they're comparably sized and they just kind of march slowly ahead. Sort of like what happened right here. If I see that sort of pace, that's sustainable. Whereas if I see something where the bars are stretching far away from the top of the channel, way above it, or if we were going down way below it, that would be a strong indication that that pace is not sustainable. In other words, the more extreme the bars get away from the top of that channel, the more they start to pull sharply away from it above it or sharply away from it below it, the more likely you're going to get a very aggressive pullback. So those types of moves are not likely to be sustainable, but the ones that are more steady, they're consistent, they move up, they're moving quickly, but they're moving steadily. Those are the ones that are most likely to be the ones that are going to give you the opportunity to project the future price movement. And again, it's within the first 15 minutes that you should be able to do that. So as long as you're finding stocks that are making strong moves early, you could do that very effectively. The other thing we have to keep in mind is the volatility. As I mentioned, when the stock gets far outside of the channel, rapid pullbacks are likely, like we saw here. Okay, we get a sharp pullback after we have a sharp move outside of that channel. Now, with that in mind, the width of these price channels, these Bollinger Bands, basically tells me what type of volatility risk I have to accept. If I'm getting into a trade where the bands are fairly stable and steady, especially like they were right here, where they actually narrow and form a much tighter range, then I can accept smaller amounts of risk. So if I get into my options position here, I only have to accept a risk down to about there to know that it's probably time to get out. In other words, to know that I got in at the wrong timing. Whereas if I try to get in here, I've got to accept a much wider amount of risk, and most likely it's not going to be sustainable anyway. So I'm probably buying very close to the top of the range where the options are going to cost the most. And then as soon as it's over, then my options suddenly lose dramatic amounts of their value. In other words, the pullback here almost certainly would make an option lose about 30% of its value if I'm day trading it. Whereas if I get a smaller pullback, let's say that goes to here, most likely those options would not lose the same amount. In fact, they'd probably lose a lot less than 30% of their value. So in short, I want to always focus on how much volatility risk I have. I don't want to be so aggressive that I'm trying to get in where the risk, the degree of movement back and forth that I might experience is too strong. I want to get in where things are more steady, they're more stable, and that way if things go the wrong way, I can know a lot faster that I'm on the wrong side of the market before I lose a substantial amount of money. I'm still going to lose, but I won't lose as much as I would if I get in where the volatility is much greater. Okay? So hopefully that helps, folks. Thanks.